Hey everyone, welcome back to Corporate Decoder, the place where we dig into company filing so you don't have to. Today we're looking at Sunlands Technology Group's latest annual report, which sounds like a relaxing vacation, but trust me, it's anything but. Think less sandy beaches and more complex financial arrangements. We're going to decode their numbers and hopefully get a picture of where this online education company is headed. Sunlands, a player in China's online adult education market, runs its business through a complex structure involving something called variable interest entities, or VIEs. This setup is used because Chinese regulations restrict us like the internet. Basically, it allows companies like Sunlands to operate in a grey area, which we'll have to analyze for risks. Sunlands Technology Group is based in Beijing, China. We see here the contact email is lutongbo@sunlands.com, which is an easy enough start, but we will be taking a look at some of the more difficult details of this report. Sunlands is listed on the New York Stock Exchange under the ticker STG. That's where their American Depository Shares, or ADSs, are traded. This is the equity we, the investors, are concerned with. So if you buy STG, you're buying into this Cayman Islands holding company that has contracts with companies in China. The VIE structure is a legal workaround that lets foreign investors have exposure to China-based companies even when direct ownership isn't allowed. However, if the Chinese government decides this structure is illegal, Sunlands could face serious penalties. This could include being forced to give up control of these VIEs, which generate a large chunk of Sunlands revenue. In 2024, 83.9% of Sunlands' total net revenues came from these VIS, which really highlights how critical these VIS are to Sunlands' overall business. It's a lot. If something happens to the VIEs, it will be catastrophic to the bottom line. The company mentions that their PRC legal counsel believes the VIE agreements are valid, binding, and enforceable under current Chinese laws. Always a good thing to get a second and even a third opinion here, especially if there are major red flags. Recent regulations are mentioned, including the revised cybersecurity review measures, which makes compliance extra important. Any negative findings could halt operations or significantly change how Sunlands does business. There's also potential for the China Securities Regulatory Commission, or CSRC, to require filings for overseas listings. If Sunlands can't complete these filings, it could face penalties and restrictions on offering securities to investors. Sunlands has made significant capital contributions to their PRC subsidiaries through an intermediate holding company, totaling $200 million. This cash has been used by our PRC subsidiaries for their operations. This tells us the holding company is committed to the region and is actively investing here. The board of directors has previously declared a special cash dividend, but they are retaining earnings to grow the business. This is a good signal for investors. And it tells us that in 2024, Wuhan Shangdai declared a cash dividend of RMB 100 million, US 13.7 million, Rs 324. Here's a hypothetical example to illustrate how much of a tax might be paid. If Sunlands has $100 of pre-tax earnings, and we assume they want to pay it all out to shareholders outside of China, the real net distribution might be closer to 67.5, with 25 lost in income tax and 7.5 lost in withholding tax. Let's jump to the income statement. Third-party net revenues for the year were 1.99 billion RMB, and the company had a net income of 342 million RMB. Looks like a pretty profitable year. Now for the balance sheet. Cash equivalents and restricted cash is at RMB 507.2 million. Total assets were RMB 2,121.21 million, with deficits of investments in subsidiaries and VIS as 979 million RMB. For the cash flows, the net cash generated from operations equaled to RMB 95.5 million. So what do we take away from all this information? Sunlands seems to be navigating a tricky regulatory environment in China by using the VIE structure. However, this structure brings its own set of risks, since China could change its mind about the legality of these arrangements. The company is explicitly telling us it could get caught by the government, which really gives us a feeling as to how much of a risk this could be. Financially, the VIEs are super important, and this has some implications for the taxes. However, and this is a big one, there's no guarantee these arrangements will hold up. Overall, while they are making pretty good money now, there are some big risks to keep in mind, which are probably why their stocks do not trade for that much. And always keep in mind that an investment in Sunlands is probably based on your tolerance of the political and regulatory risks. That's it for this episode of Corporate Decoder. If you found this breakdown helpful, please leave a like, comment, and subscribe for more deep dives into the world of finance.